We have Mr. Usman Tariq, manager at BADRI, who will be discussing IFRS 17 and beyond implementation. Please join me in welcoming him on stage.
Thank you very much, Shruti. As Shruti has mentioned, I would like to repeat my name. I'm Mohammed Usman Tariq, and I'll be presenting IFRS 17 section today. I hope everyone is fine and breathing well after IFRS 17 implementations, because I know it was a bumpy ride, it was a tough phase for the whole industry, and it was a challenging phase. But the best part is that we are standing here and discussing about it. So I think it's done, and now things will be start moving towards refining and improvements. So let's hope that we take this thing further in a better way. I'll be presenting IFRS 17 beyond implementation. I have tried to split my presentation into 3 sections. Majorly recap on IFRS 17 implementations. I'll try to wrap this section as quickly as possible, because we have to discuss about more important points in the later slides. So in recap, I'll be talking about regulatory landscape and solution consideration. In the outcome of IFRS 17 implementation, I'll be talking about crux, industry snapshot at Q3 2023, and role of actuaries. Finally, I'll be moving to post-implementation observations. In that, I'll be talking about hot topics of IFRS 17. There's not much research on that, but I've gathered as much information as I could and have a fruitful discussion. So post-implementation topics are relating to human resource planning, solvency, capital, budgeting and planning, controls, audit practice, and things like that. So I'll be moving forward to GCC regulatory landscape. So UAE, Kuwait, UAE, KSA and Bahrain, they have published their results for Q1 2023. Kuwait is, for Q1 2023, there was a deadline of 14th August in Kuwait, and Q3 2023, it was 2 days back, 14th of November. Oman is having a deadline at 30th November. And Qatar, a few companies have published their results in Q1 2023, and major chunk of it is going to implement it by 1st Jan 2024. Solution consideration. So I have added. I know many of you have gone through this phase, but still, if some of you are struggling with that, it is going to be a good repetition on how to select a solution. So there are 4 points, key points that you have to consider. One is you have to see right partners, like if they can help you in your tough times, and they can explain you things well. They would work with you like a team. So if that is there, it is an important edge for you. Price, obviously, I don't think I have to mention that as a point, because price is definitely a factor that you are considering. Easy to use. If a solution is easy to use or not, as in how easy it is to, because eventually you'll have to learn it and eventually you have to do it. So you'll have to see if the solution is easy to use or not, and is it consuming that much of resources or not. So that is another cost that you'll have to consider. Outcomes of implementation, crux. So it was not easy for the industry to comprehend the results. It took multiple iterative runs to get to IFRS 17 numbers, and actually it was very critical to settle down IFRS 17 numbers first, because that was the key to success of the project. It took a lot of time in sorting out data issues, and we are all fully aware of that data issues were there, and it took a lot of time to settle them out. That is why it took some time, and implementation took longer than it was planned. Even after the extension of 1 month, people still struggled. There were a lot of stress moments. There was a lot of panic moments. I don't know about you, but I believe it was the most stressful period of my career, but I don't know how you think about it. So, and one reason why it took time was when you're planning things out, you are not foreseeing what can be the unknown factors. When you start executing it, then you get to know, okay, system is not running, this thing is missing, so data is not reacting the way it should. So when these things come, timelines become more tighter. As in deliverables, become more difficult. So that was one reason that happened, and IFRS 17 requires a lot of collaboration between different departments. Like if it's actuarial departments, it's finance department or IT department. You cannot work in silos. If you are working in silos, it will turn out to be a failure of the project, and we have seen such cases in our experience. So you cannot work in silos. You have to think about your company, not for your department, because eventually company is for something that departments are made. So you have to think about your company, not your department. That is something which is very important to consider. Secondly, key understanding of differences between IFRS 4 and 17 were missing. So it took a lot of time to get us feedback, like if you have shared the results. So feedback from the companies were coming very late because the key understanding of 4 and 17 differences were missing. That and a lot of hand-holding was done by the consultants at that point of time. So that was done. Eventually, as I've explained before, it is an iterative process. So if you are having a data and you cannot tell what are the problems by looking at the data. You have to put the data into the solution, you have to run it, you have to get the results out, and then by looking at results, you'll get to know what is happening there in the data. Then you go back to data, you see, okay, here's the problem. So it is a time-consuming process, which we need to understand, that it's not that by looking at a data, you can tell where the problem is at the start. Then industry snapshot at Q3 2023, increase in revenue by 17%. Insurance service results have declined by 14% in Q3 2023. Profits have shown an increase of 19%. There is a strain on the solvency as in this period, and probably there is a circular that was withdrawn by the regulator, which was giving discounts of 50% on motor rates. We're expecting that results will be improving in the future for that. And we're expecting that published financials will improve with time because the more you're getting familiar with the data and the more processes are improving, we are expecting it to get better financial statements in future. Role of actuary, it has changed a bit after IFRS 17. Actuaries will have to work very closely with finance teams. They were working with finance teams closely, but now since it is an accounting standard, they'll have to think like an accountant, how they can help them in understanding how payables and receivables are impacting their financial statements. So support in terms of preparing input files for the solution has also been provided by actuaries. So that is one thing. It is not an easy task. That is why help of actuaries is taken from there. And actually had multiple meetings with the auditors, with the implementation partners to understand how input files were prepared and how to convert the data into the required format of input files. That was another thing. So eventually, I believe this actuaries will come back to their original, or you can say conventional role, which is reserving and pricing. But it completely depends on the companies if they want to build an in-house capacity for that, or they want to outsource that function. that is up to the companies, and where there are actuarial consultants that have built their in-house solutions, their actuaries are also working as implementation partners. So that is another thing. Post-implementation observations. So I've already mentioned these, but these are the important topics. Firstly, is human resource planning. The first problem is that IFRS 17 related skills are there's a shortage of people having IFRS 17 skills or that are well versed with IFRS 17. That is one problem. Another problem is there are parallel reporting in UAE, and you have to do IFRS 4 and 17 together. So you need additional resources for that. But the problem associated with that is once IFRS 4 will die out, there would be redundancy in the resources. So these are two major problems that can happen. Obviously, but the current requirement for parallel reporting, that is taking too much time, that I understand. And roles of finance and actuaries must be redefined within the organization. How responsibilities are changing, how roles are changing, because there are some additions to finance team and there are some additions to actuarial team. Again, collaboration is a key to success for IFRS 17. Key performance indicators, no change in lifetime profitability, but profits the timing will change. To date, KPI for IFRS 4 are largely retained. It's just that the definition and the way they're calculated has changed. So, like I mentioned, the IFRS 4 is largely retained. Combined ratio is still there as a significant KPI, but the way it is calculated, it's slightly different. I'll go through that in the next slides, but I won't be going through all the formula. We can share these slides with you if that is going to help. So in combined ratio, the impact is additional impact is for risk adjustment, discounting, and the allocable expenses, attributable expenses that are the definition, the way it is changing. So this is how I've split. Sorry, when I move there, I think my voice slows, as in it reduces, so I'll have to stick to this. I've split it into before IFRS 17 KPIs and after IFRS 17 KPIs, and categories are there for growth and profitability. If you can see, thank you. Yes. So if you can see that in combined ratios, since this is without IFRS 17 and this is after IFRS 17, in the combined ratio, if you will see, it is gross and net basis both. The way it is calculated, it's insurance service revenue, insurance service expense over insurance service revenue. I'll also move that to. So if you can see, if the IFRS 17 combined ratio gross insurance service revenue over insurance service expense, and if you want to get it in, let's say, a net combined ratio, you will add reinsurance results in the numerator. So we will be sharing these slides with you if that is the case. These are the other formulas, but I'll be not going into detail given the limitation that I have for the time. I'm sorry if I'm going too fast because I have to cover topics that are needed. Then we'll be going to budgeting and forecasting. In budgeting and forecasting, IFRS 17 has changed financial statements significantly. So in order to understand that, it is not very clear to shareholders that how it is impacting. Although IFRS 17 has increased the granularity of data and granularity of things, it is now getting into more detail and well-informed decision. So if you're making a well-informed decision, you can get better decisions on business mix strategies, capital optimization, areas of expansion, selling and acquiring of portfolios. But this will not come easily. It will be a pain for planning teams, and they will have to integrate IFRS 17 numbers now, which is not easy. Given the complexity of this, it will probably take more time in getting the numbers out than analyzing them. So that is one thing you'll have to keep in mind, that teams are spending more time on analysis and not on getting the numbers out. The level of aggregation and CSM and loss component will exacerbate the problem, because the more aggregated your data is, the more number of rows you have, and you'll have to take care of CSM releases and loss component releases. So companies, it's better that they integrate IFRS 17 solutions with this process. It would be very helpful for them, and they'll have to keep computational power in their mind, that how they can reduce manual intervention and keep things towards automation. That is another part for budgeting and forecasting that you have to consider. Solvency and capital. Again, there are many question marks on this topic. There are two things to consider. One is that if inputs will change in the e-forms, like currently the setup we have in e-forms is you're plugging in numbers and you get a solvency number. How those inputs will change in IFRS 17, that is one question. And how it will impact, that is another question, because impact is unknown. It will vary from company to company depending on how IFRS 17 variables are moving. And the second part is, if we want to see what is the solvency position, do we need to use proxies for that? Again, if we are using proxies, it is not clear that what is going to be the impact of on the solvency, because it will be varying from company to company. Currently, there's nothing coming from UAE regulators on that, but eventually if we are using proxies, it is not going to be a short-term solution, because we will have to, regulator will have to jump in and tell what we are going to do. Either we'll change the formula or we'll change the inputs, how it is going to impact. That is something where regulator will play its role. In KSA, regulator is working on it, and they've done some internal studies. They are doing it in a phased manner. The impact of the transition impact, I would say, in both the region was like in UAE, it was 290 ahead of 297 million, which is 1.5%. Of opening equity at January 2022, 24 million impact, which is 0.1% of the opening equity at 1st Jan 2022. Investors' view. So investors are, in case of that, analysts are not up to speed with IFRS 17. If analysts are not up to speed, there's nothing for investors to see and make decisions. So currently, more theoretical debates are going on, but now it's time to get hard numbers. And when we will get the hard numbers, only then investors can make a viewpoint of it. So it's a learning curve for analysts and difficult for investors to make a viewpoint. So investors, they need educational events and presentations. You need to understand how investors are thinking, what they want from IFRS 17, what they are interested in. Historically, it was observed that they are interested in roll forward of insurance contract liabilities. So in that case, probably one reason could be because it has all the key figures of IFRS 17, LRC, LIC, risk adjustment, loss component. So probably that could be one reason. And moving forward now, it has seen that they are more interested in sources of profits. So sources of profits can be considered as insurance service results, which is underwriting margin. You can think of it as underwriting margin, and net finance results, that you can think of it as investment margin. Underwriting margin or insurance service result consists of insurance revenue, insurance service expense, and it is the effect of insurance contracts. And investment margin can be considered of insurance contract income and expenses and return from other assets. And on top of it, where there are long-term contracts, where there are live contracts, investors are also interested in disclosures on CSM. So let's say if you want to further dig it down, or investor is more interested in to see that what is the underwriting margin, and we know that it consists of 3 parts. If you want to further dig, it down, like insurance service expense, that you can then think of it, okay, it has more components, that incurred claims and incurred expenses. It has a release of acquisition cash flows. It has change of past service like LIC. It has changes of future service like things like that. So if you can further dig it down, if you want, if you are more interested in seeing what are the sources of profits. Controls. So companies need to ensure that they have necessary systems in place for reporting, collecting information and storing information. Model risk is going to be a huge risk especially for life insurance companies and life insurance products, because first cash flows were projected to calculate the reserves. Now cash flows are projected to prepare the financials. So there's a huge difference now. And since model risk is there, you need to make sure that the models you're using are robust and transparent. There are no black boxes. Your team has sufficient capability of tweaking the model and understanding the model. So these things you'll have to keep in mind. Then companies will need to allocate sufficient resources to see if they are compliant with IFRS 17 or not. Other than that, since I've mentioned, there are multiple reporting frameworks like IFRS 4 and 17. Currently, we are trying to reconcile them. Eventually, when IFRS 4 will die out, there won't be any requirement of reconciling it. So it will eventually, things will become better. And processes need to be in place to have improved collaboration. And we have to minimize manual working and focus on automation. Document your assumptions as much as you can. Audit practice. There are no set standards for auditors at this point of time that we have observed during implementation. It is shaping up with time. And it is a learning curve for auditors as well. It was a learning curve for every one of us. So similarly, it is a learning curve for auditors. I believe their implementation teams have sufficient resources and information about it, but where their auditing teams are there, they will need to pace up with the things. So currently, there is more focus on IFRS 4 and IFRS 17 deviation. Eventually, IFRS 4 will phase out, and the comparison will go to IFRS 17 and IFRS 17. So this is the next thing that is coming that auditors will be focusing on. This is something that auditors will be working on. Please expect tighter audits with time. Currently, they were not as tight as they are going to be in future. That is what we are expecting. And we are at minimum compliance at this point of time. Things are improving, and we'll be improving with time. It's not only any one of you, it's every one of us that is going through this. Key learnings. Thank you for listening to me so far. This is the last topic I'll be talking about, and it is the key learnings that I have gone through, or we have gone through in the industry. Companies are still not sure how IFRS 17 variables are impacting their income statements. There's no straightforward expectation. I think they need to understand now that how it is impacting, how these variables of IFRS 17 are impacting the financial statements and income statements. So that is something which is required, and companies should understand fully to get grips of it and make an analysis. Companies are trying to match it with IFRS 4. Please start coming out of this comparison, because eventually IFRS 4 is not going to be there. It's only IFRS 17. So that is another thing. there is one interesting understanding that IFRS 17 can improve your results. This understanding, I request everyone to please, this is not true at all. It's just that what you're writing, you'll get in your books. If you're writing bad business, it will show as bad business. If you're writing good business, it will show as good business. It's not that you're writing a bad business and you've implemented IFRS 17 and now your business will look good. This is not going to happen. Please, this can go in any direction depending on, again, variables of IFRS 17. So understanding of data has improved, but struggle is not over yet, but it will eventually over. Expect tighter scrutiny from auditors end of this year. Please be prepared for it, and we are also prepared for it. Bare minimum is done. We are moving to improvements. Currently, non-life insurance companies have tried to fit their every portfolio in PAA. Please expect hiccups when you are moving to GMM. That is going to be a mini implementation, or probably this is an intense word to use. It is going to be, there are going to be hiccups, so please be prepared for it. Understanding of solution implemented in different companies is limited, so companies will have to start getting into it, because eventually you have to do it. You have to start understanding how system is working, solution is working. As per my estimate and expectation, another 1 year will take for the complete handover. But there should be a conscious effort from you to start understanding the solution, how you have to, because eventually you have to work on it. Last but not the least, process needs refinement, because there is too much pressure on getting the financials audited. So you need to have processes in place. Either you can close your quarters earlier, or some creatively you can close this, or you can decide the timelines that when you are going to share the data with people, when analysis is complete, when is it going to go to auditors. These things should be in place so that there is no stress moments at the last time. So I think this is what I wanted to discuss, and I'm done with my presentation. Thank you very much for listening to me. Sure.
Thank you. Thank you for the presentation. I'm Zahir Iqbal from United Insurance Brokers. Just want to understand your take on the solvency calculation under IFRS 17. So the first question is, like, where are the regulators on that at the moment? The second question is, what are the variables that will be different than calculating the solvency under IFRS 4?
Right.
So what will be the major challenge?
Right.
Second question, which is my last question, you said the auditors are just trying to understand and learn. I mean, it's a journey. Well, being an accountant, an ex-auditor, so we have guidelines under the IFRS that we have to rely on the work of an expert. So what's happening right now is the auditors are relying more on actuarial work rather than the accounting work. And you said you can expect, or the industry should expect, tighter audits from the auditors. Now the question is, consultants have done the majority of the work for IFRS 17, data inputs and everything. And the accountants or the finance team of the insurance company will follow the pattern which has been set by the consultant, the actuary. So what is your view, keeping in mind the IFRS says that the auditor must rely on the work of an expert. However, in parallel, they should do some testing to validate that work conducted by a third-party independent.
Right. So first question was on the solvency, that how variables are impacting. So I can explain that by saying, let's say if you look into your e-forms at this point of time, the input is going, there are two major inputs, I would say. One is technical provisions and one is written premium, right? So they don't exist in IFRS 17. A regulator will have to come up with something like related to, if in case of technical provisions, we are going to put LIC. LIC will have your technical provisions plus risk adjustment plus discounting. Now, what would regulator want? Does he want us to stripe out impact of risk adjustment or discounting from the LIC and then put that as variable? Or regulator wants us to put all of it as an input? Similarly, if we want to put written premium or insurance revenue, these questions are required to be answered by, ideally it should come from regulator, because we can, if we will decide on our own or use proxies for that, you will be doing something else, I'll be doing something else, or someone else will be doing something else. It is not going to be a fair comparison between companies. So that is answering your first question. Second question is, like in case of auditors, we are expecting tighter scrutiny, because let's say I can explain you with examples so that it is easier for you to understand. Let's say we are currently, what we do is when we are calculating onerosity, please let me know if I'm getting too.
No, it's totally understandable. Thank you.
So if you're calculating onerosity, or let's say we calculate a loss component, currently what assumption that we're using is that where there is PDR, we consider that as onerous, which is fair, but it is the bare minimum. It is not. Initially, auditors were fine with that. Now we have started getting questions that no, that you have to do separate analysis for onerosity, like for each underwriting year. You will have to calculate that if the GUCID is onerous or not, and then you're going to come up with the loss component. So that, here things are changing now. No, auditors, initially we were doing PL eligibility testing in previous years. Now they're saying that no, we need it for this year as well, because so they are coming up with stringent, or you can say tighter requests that are going to be a little challenging, but I think this should be fine. Eventually, this is how it is going to improve, as in the processes will improve. And what auditors are doing is they're trying to understand the processes from different companies. We're getting requests that please explain us how the process is done, to understand at each step if there are data leakages or not. So that is how I believe that auditors, and in case of third parties, they are using actuaries to be part of it, part of their teams. But yes, I think the accounting part, they'll have to, like on onerosity, it's a decision that can we use PDR or not. That is not purely coming from the actuaries. Auditor can also make a decision on that, or he can also make a viewpoint on that, because it is not as technical. It's a decision-making thing. It's a decision-making process. It's not as technical thing that it should go to actuary or something. So that is what my take on this. Thank you.
Thank you.
Is there any question? Anyone else who wants to? I'm sorry, I'm having a bad cough, so.
Hi, my name is Sachin from S&P Global Ratings. My question is on the comparatives you talked about and the data. So what IFRS 17 has introduced is the discounting concept, and every company has to, of course, demonstrate how they choose the discounting rate. For us, we do global comparison also. So how do you see within the market companies using consistent discount rates? So is there any consistency from the regulator or from the auditors that there is a real comparison between the discount rate is used by different companies, and of course whether this region can be compared to the global peers, because when you compare it to companies in Europe, they would be using totally different. So that consistency is still, I think, the challenge for us.
Right. Thank you. See, what my point of view on this is that if you need a consistency in a market, it ideally comes from regulator. And when regulator will give guidelines on how and which discount rate is to be used, only at that point of time we are going to get the consistency in the industry. Otherwise, it is very difficult to set any expectation. We all will be using different discount rates. Let's say if we are using EOPAR discount rates with country risk premium. Generally, we have seen this is as industry practice. This yield curve with country risk premium, even in KSA, and but things are moving again. Since it is a learning process for everyone, it is improving. People in KSA, that I think things have changed because regulator is very active there. But in UAE, it's just a race that we're in, and we're expecting that things will come up from regulator in the near future, especially for this, like you said, discounting and solvency. So that is what I think, and consistency is going to be achieved once regulator will jump. That is what my take on this. Thank you very much, everyone, and thank you for being patient and listening to me. Thanks a lot. Thanks.